Today we're going to talk about a strategy that can be used to enhance long-term investment returns. This video is not intended to be financial advice. It's for education and entertainment purposes only. You can do things like paper trading to learn more about this strategy, but you should do your own research as well. You can use this strategy to enhance your long-term investment returns and profit off of a market that's kind of trading sideways. And as such, it can be a sort of income stream. This strategy uses options to enhance those long-term investment returns. And in simple terms, an option is a contract to buy or sell an underlying security at a given price within a specified time frame. Buying a call allows for you to purchase an underlying security at the strike price within a specified time frame if it is in the money. Selling a call obligates you to sell the underlying security at that given strike price if it is exercised. Buying a put allows for you to sell an underlying security at a given strike price within a specified time frame if it is in the money. Selling a put requires you to purchase the underlying security at that given strike price if it is exercised. The strike price of an option is the price at which the underlying security needs to be at or beyond in order to be exercised. If the underlying security price is at or above the strike price of a call option, then that contract is considered in the money. If the underlying security is at or below the strike price of a put option, then that contract is considered in the money. So each contract is for 100 shares. So when you see the price of a contract, you really multiply by 100 in order to get the total price to purchase or sell that contract. When you exercise a call option, the underlying security is purchased. When you exercise a put option, the underlying security is sold. Now that we covered the basics of what options are, we're going to get into what this strategy actually is. We're not going to focus too much on how to select companies to do this with, but understanding a company's business model is helpful when selecting long-term investments. If you're not already doing long-term investments in individual companies, then ETFs is probably a better option to start doing this strategy with. Again, we're not going to spend too much time focusing on how to select individual stocks, but value investing is one strategy that you can use to select long-term investments. So people like Warren Buffett use this strategy, and the price-earnings ratio can be used to determine a good price for an individual stock. But drop a comment below if you want to see a video follow-up for the concept of value investing. Once the underlying securities have been selected that you're going to execute this strategy with, then you set alerts on whatever app, Yahoo Finance or your brokerage, for when that underlying security is going down, and sell puts at the exercise price that you would be happy to own the underlying security at. If the contract expires out of the money, then you keep the proceeds from the sale of that contract. If it expires in the money, it will be exercised, and now you will own that underlying security at the strike price minus the contract value. So after some of those put contracts have exercised and you own the underlying security, you start watching the market for when it goes up, and you sell call options, which would be considered covered calls since you own the underlying security. If the underlying security's price goes down, then you could sell more puts to enhance your profit again and possibly get more shares, and then your call options will expire out of the money. If the underlying security's price goes up, then it expires in the money. Now you will have to sell at a profit, and you add the contract price to your profit. And this is how you can profit in a sideways market. So whether the market's going up or down, you can make money and profit. Let's talk some risks. If you sell puts and the underlying security goes down significantly further than the strike price, then you're going to be starting a position at an unrealized loss. You also have the ability to do what's called a buy to close in order to not have the underlying security when it's going down significantly. But that gets expensive, and we're not going to talk about that in this video. Drop a comment below if you want to understand that a bit more. If you sell calls and the underlying security goes up significantly beyond the strike price you sold that call at, then you're forced to sell at the strike price, but you're already profiting, so this may not matter. However, you might have to sell the underlying security earlier than you had hoped. The concept of a wash sale prevents you from deducting the loss from the sale of an underlying security when you have purchased it within a 30-day period. So I'm not going to dig too far into what this is. Drop a comment below if you want to understand that a bit more. Drop a comment below if you can think of any other risks that I'm not covering in this video. You really shouldn't be doing a strategy like this unless you have some actual trading experience. So something like paper trading is what you should do to start out. For individual companies, if you can find contracts expiring within a week that are more than 1% of the underlying securities price, then that's pretty good. For ETFs, if you can find contracts that are expiring within a week that are 0.5% or more than the underlying price of the ETF, then that's pretty good. It's quite likely that when you're using this strategy, you're going to experience some short-term capital gains. So if you're executing this within a Roth, now you're shielded from the taxes on those gains. So the power in this strategy is when you can understand how a given security moves in a week period so that you can continually do this strategy and have contracts expire out of the money. If you want to learn how to do that type of analysis, drop a comment below. We're going to walk through some quick examples. The individual security that we're looking at is Zscaler. I didn't select this because of some kind of attachment to this share. It's actually just because in the market movement, it was a security that was going down in price at the time of recording. We can see that the underlying security is $104.66, and a contract at $102 as a strike price is $2.02. This is over 1% of the share value, and when you sell that put contract, you would get $202. At the time of this recording, Zscaler is going down, so the call contracts are going to go down in price, But if we take a look at this as an example, you could sell a call option for a $107 strike price for $2.10. Maybe you previously owned this. But right now would not be the time to sell these call options, because when the market goes back up for this underlying security, that would be the time to sell it, and you'd be seeing higher numbers on those call option contracts. SPY or SPY is an ETF that is good to execute this strategy with. And in this case, we're seeing that the underlying security went up for the day, so the put contracts are going down in value. But we can still see that some of these things, like $393 strike price, is still $2.07, and that would be over 0.5% for this underlying security. And we can see here that with SPY trading at $396.96, we could sell an option of a $400 strike price for $2.42 per option, or a total value of $242 for that options contract. We hope you found this video informative. We don't recommend doing something like this until you've built a strong financial foundation. We talk about strategies that most other finance channels don't talk about. Learn about them in these videos, and subscribe for more content like this. You can find a link to book a meeting with us for a free consultation in the video description. Thanks for watching.